Good day, friends. My name is Yuvraj Chaudhary, and I am excited to welcome you all to the Market Perspective podcast by Emkay Wealth. Today, we have with us Head of Products at Emkay Wealth, Mr. Ashish Ranawade. Sir, welcome.
Hello.
It's always a great opportunity and an honor to speak to such stalwarts in the industry. Sir, so let's get right into it with my first question. There's a lot of chatter around in the markets about U.S. trade tariffs, U.S. China trade talks, and of course, UK India trade talks. Now, when we look at Indian markets, it has delivered around 13% in the last 1 year. US and China giving around 7 and 25% in last 1 year. So how do you think the global investing is shaping up?
So let me start by saying that what we are witnessing right now is unprecedented. I mean, we've never seen something like this in the last 20 years or so. If you see, tariff or other trade barriers have been coming down sequentially over the last 20 years. And now suddenly you have one of the largest economies in the world saying that I am going to introduce tariffs, and these are not small tariffs, these are big ones. What the US president has done is let the cat amongst the pigeons. We really don't know the outcome of it. But having said that, assuming that he knows what he is doing, his target is to make, or his objective is to make America great again. Now, if this is the right way to do it, and if this is the right thing to do, then, and if he achieves even half his objective, then I would say once the dust settles down, of course, right now we are still in that uncertain territory. We don't know which direction it's going to settle, but I'm assuming that roughly in the next 1 month or so, at least the discussions or the negotiations will settle down, and another 6 months for the supply chains and everything else related to trade to reorganize and settle down again. So broadly 6 months. After 6 months, we'll know the direction in which we are headed. But coming back to what I said, if he even achieves half his objective of making America great again, there are two implications. I do not want to stay away from the US markets, because if that economy, there is going to be a structural change, and the domestic part of the economy starts doing well, then I would want to be in that market for sure. And it's a large market. So I would say want to do SIPs, or I would want to start investing in the US market in some way. And we've been recommending to our investors since last 3 years that you should have a certain allocation globally. And it can be 30%, it can be 20%, depending on how or what number the investor is comfortable with. But there should be a certain allocation as far as global allocation is concerned to equities. Now, your second part of the question was about China. I do not like China for a simple reason that it's not a democracy. It's not a capital economy. And to a large extent, policies in China are dictated by the government. So it's not a free market. So it's very difficult to take a call on which stock to buy in China. And historically also, if you see the Chinese market, not in spite of China having seen phenomenal growth over the last 15 years or so, the Chinese markets have not done so well. So why should they do well going forward? So I'm not a great China fan, so I would stay away as far as the Chinese market is concerned.
Since we're talking about equities, how do you think one should plan or allocate his funds, his or her funds? Should it be a small cap? Should it be a mid cap? or a large cap, or a mix of all? How do you think one should allocate his funds into a portfolio?
Okay, so before I answer that, we are bullish on India. And we are bullish on India because there is a structural change happening in India. The per capita income is going up. The middle class is burgeoning. The government policies are such that they are encouraging manufacturing, which basically means job creations, which also means a whole lot of opportunities here. Not just from a pure manufacturing also, but the recent war with Pakistan has shown us how technologically advanced India actually is in defense. And this whole defense thing started just about 10 years back. So I think India has great talent. India has great potential. So I would want a bulk of and India has growth. So I would want a bulk of my investments to be in India. And now coming back to creating an overall portfolio, I would classify large caps as let's say some of the large US stocks. Now, companies like Amazon, Google, Netflix, Uber, they are present across the world, and including in India. They are capturing a large market share in India and of course globally. So my core portfolio, so I would divide a portfolio into two categories. One is core and the other would be non-core. Core would be stable, relatively less risk, relatively stable growth, whereas the non-core would be something which gives you that high beta, which gives you that very high risk, high return kind of, which it typically would have a high risk, high return kind of a profile. Now 80% of my investment portfolio would be core and 20% would be the high risk non-core. Within 80%, I would assume that there would be a significant percentage of fixed income involved. And then within equities, there would be the large caps, and the large caps would be typically the companies which I mentioned, like Amazon, Netflix, Google, Apple, Microsoft, which are global companies. And then I would come to the Indian large caps, the ones which have significant earnings from within India and which are a play on the growing Indian economy. And then we come to mid and small. And I think in this kind of a growing environment, the small caps have the best risk return profile at this point in time. But then the small caps typically come into the non-core. So I would say one has to look at the overall asset allocation, and then one should look at in terms of how much of large, mid and small one should have. But I think the time is now right to relook at small caps as a high risk, high return kind of a profile opportunity. And I know that there have been some fund managers who've come up in the month of Jan saying that small caps are expensive, small caps are high risk. There's been a significant correction now, and I think an active fund manager should be able to get these opportunities into your portfolio. So that's broadly how I look at the overall portfolio allocation.
So you mentioned asset allocation in your answer. I just want to take this discussion to gold. Now, when I see gold, I see a huge rally since last 1 year. Now, there can be multiple reasons to it. It can be geopolitical tensions also. How do you think gold is going to turn out in the next 1 year? And looking at an asset allocation point of view, do you think we should include some of our allocation into gold? And what kind of products do you recommend to our investors, you being a product specialist?
So gold has rallied because of two reasons. One is there is central bank purchase of gold because of all the uncertainty which is happening around. And there is probably rebalancing of central bank assets globally, which is why they are increasing their allocation to gold, and of course the retail demand for gold. Now, the rally in gold has been phenomenal. Now, is it possible that central banks continue to accumulate gold and investors continue to allocate resources to gold and gold does another 25%? Yes, that's a possibility. because fundamentally the reason why gold went from point A to point B today can take it from point B to point C. But would I ask somebody to increase his allocation to gold at this point in time? I would say no, because we've been recommending something like a 10% allocation to gold over the last 3 years. Now, somebody who doesn't have that 10% allocation to gold and says, okay, now is the time when I want to have that allocation, I would say look at a product called a market-linked debenture. A market-linked debenture is a product which gives you the upside of a gold while preserving your capital. Now, just in case gold doesn't do anything for the next 3 years, or let's say gold corrects over the next 3 years, in which case, that additional allocation to gold may not make sense. But if you take that position through a market-linked debenture, at least your downside is protected and you get some upside which is related to gold. So there are a lot of such interesting products in the market. So like as I said, gold MLD is one. You also have a Nifty MLD for investors who are concerned about what's happening and they do not have the risk appetite of investing in direct equities at this point in time. You also have a Nifty linked debenture, which is a good product for these kind of investors.
All right. So we talked about equities, we talked about gold. Now I want to touch upon the third aspect of portfolio allocation, which is fixed income. Now, given the interest rate cycle that we have currently, we are in a downturn. Where do you think our interest rates are going to end up in the December quarter? Also, what kind of products are you looking at, when it comes to fixed income? A lot of our investors' wealth is into fixed deposits and fixed income products. So, your views on that, please.
So, it's very clear that we are in a down cycle as far as global economic growth is concerned. And in this kind of a scenario, and interest rates are high in the US, interest rates are high across the world, even in India, there is scope for interest rates to go down. And I think we are in the down cycle. We started somewhere last year, and I think another 1 year where we'll see interest rates come down dramatically. And in that kind of a scenario, it's always the duration which comes into play. So duration, to put it simply, is the sensitivity of a bond's price to change in interest rates. So if interest rates go down by 1%, a 13 duration bond will give you a capital appreciation of 13%. It's as simple as that. Are there 13 duration bonds in the market? Yes, there are some government bonds in the market which have a duration of 13, and they also give you a coupon. So you earn a coupon and you earn capital gains. If you play it right over the next 1 year, there is a good chance that you make a good return on a government securities, and that's what we are recommending to our clients. Of course, there is an element of risk in everything that we advise or we say. So clients have to look at the suitability of a certain product as far as their portfolio is concerned. But at this point in time, I would say duration is a play which investors should look at.
All right. So in this discussion, we covered the entire spectrum of asset classes. There's one other asset class which comes to my mind when it comes to equity investing, which is an unlisted space. Now, there's a lot of chatter and a lot of noise around in the market about unlisted. I want your views on the current opportunities that we're looking at, and what kind of opportunities do you see coming in the future in the unlisted space?
So, it's obviously very high risk. To classify everything under an unlisted category means something which is like a national stock exchange, which has been trading in the unlisted market for quite some time now and which has seen a phenomenal growth. Is also unlisted, and at the same time a very small 50 crore or 40 crore market cap kind of an opportunity in the SME segment prior to listing is also unlisted. Now both cannot be compared because both have a huge difference in terms of their overall risk profile. So I would, if an investor wants to look at unlisted, I would say ignore or don't look at the top 5 or top 10 names in terms of the market cap of the companies which you want to look at. Look at more, and you need to evaluate your risk in terms of the opportunity which is being presented to you, and look at the suitability. Unlisted as a percentage of your portfolio should not be more than 2 to 3% of your overall portfolio. At the most, somebody wants to take a very high risk can go up to 5%. But I think beyond that, because there's always the slip between the cup and the lip when it comes to listing. You don't know what's going to happen, whether the company is going to get listed or whether there are going to be issues on the listing side. So that's a very high risk game, and I would say broadly investors should look at the suitability of that kind of a product to their risk profile.
All right. Thank you so much, sir. I think all our investors and all who are watching this have gained a better perspective on what we are looking at as Emkay Wealth. What kind of products do we have in our bouquet? It's always fun chatting with you, sir, both offline and online.
Thank you.
I'm sure, please, all the viewers on the channel, please comment and let us know what kind of topics do you want to discuss in our next video. Please like and subscribe the channel. Thank you.
Thank you.